All right, guys. Welcome to the July 2025 State of the Market Economic Update. And today we're going to cover both national news and national updates. And we're going to also go deep into what's happening locally. And we're going to kind of land with some scripts today to talk about how do you explain what's happening in the marketplace. And so just to give you just a little bit of a sense, a little bit of taste of what today is going to sound like, when we really look at what's happening, the economy is showing just a little bit of mixed signals. We have some things that are really strong. We have some things that are a little bit weak. We have tariffs. We've got a fight between the president and the Fed chairman, and there's some back and forth on that. If you've not seen the Kung Fu fighting meme, we'll make sure that we get it out to you because it is absolutely hilarious. But we've got the job market's cooling, but it's not collapsing. Consumer spending and confidence is holding up, which is kind of interesting. But interest rates are continuing to just weigh on housing demand. And so that's a little bit of just a perspective of what we're going to be talking about today. And today I'm really happy. I've got Chris, my co-host, who is here to share and give perspective. We agree on most things. There's some things that we have a little different perspective on, but it's about 90%. So Chris, do you want to introduce yourself?
Yeah, Ryan, and thank you. Happy to be here. Thanks for joining this call with us today. Really excited for the information that we have to give. My name is Chris Cavazos. I am the loan officer of Echelon Home Loans, and I want to just first celebrate. We had our first closing with Echelon yesterday. Yay to that! So thank you to
Yay!
everybody who I've been able to be in relationship with and in contact, and I look forward to obviously getting to know each and every one of you as time goes on as well. So I'm really stoked for the data that we have today. A lot's been going on recently in the mortgage market, and with the Fed as well. So it's kind of interesting what the Fed's been saying as it relates to mortgages, and I'm excited to get into this with Brian today. So Brian, why don't you go ahead and take off?
You got it. All right, we will dive in here a little bit. You guys, can you see my screen? Making sure.
Yeah.
Give me a thumbs up. All right, good. All right, let me click forward. You guys know me. I am the operating principal for KW Coastal Living 1 and 2. And of course, Chris, I didn't say this. And the reality is that Echelon is a affiliated business. So it's an affiliated entity and all the Coastal Living family. So when you guys use Chris, when you give him a chance at bats, that creates opportunities. It supports the market center. And of course, our goal and our vision is to A, take great care of you, B, take great care of your customers, but C, as we get to that 20 units a month, that's the litmus that we need to get to, that we can make the investment opportunity open to our agents with the goal of reducing your cap or getting you to 100% where you don't even pay the market center to be a part of it. So that's our goal. That's what we're working towards. Now, in the chat box, we dropped in a couple of one-pagers. Chris, do you want to talk a little bit about?
Yeah, sure.
Do you want to talk a little bit about buy downs? Kind of what would be the one or two really important things for them to know about you and their opportunities right now?
Yeah, so there's the marketplace is difficult. We have some of the most expensive houses in the nation, the highest interest rates, just affordability with taxes and insurance is out the window. So, we're looking for alternate types of ways that we can attract some buyers into our pool, and then also offer listings in a different sense so that maybe we can push them as well, right? So, if you look at the one pager, there's 3 of them in there. I've got a temporary buy down one. That's what Brian's referencing, and if you pull that up. What's important on here to look at is it just breaks down what it is and how much it costs to do it, right? Now, I'm not going to go line by line and everything in here right now, but I implore you to take a look at it and see what it says. And if you have any questions, of course, reach out to me directly and we'll go over it one-on-one. But there is a really good benefit because, you could have a large savings in the first year, 2 years for your client, while interest rates are going lower and then refinancing later. So just opportunistic time to be utilizing that. So again, if you want to go deeper into it, I'm happy to reach out to me.
Great. Thanks, Chris. I appreciate that. And yeah, a 2-1 buy down, a 3-2-1 buy down, a 1-0 buy down. Those are great tools to reduce that first or second year interest rate. And that's a great way to move a buyer to a choice point in this market. If they're concerned about rates are probably going to be lower next year. We're kind of at that spot where probably can't be higher, to be candid. And so because of that, those two ones give them a little bit of time to get used to that, let rates slow down, and then do a refi down the road. So good. Let me drop back into the presentation. Okay, so let's talk about what's happened since our last call. And it's been a little bit of a wild ride, although I'm going to say it's been a little calmer maybe than the last 2 or 3 months. So tariff negotiations have continued to develop, and the tariff related inflation that everyone was super concerned about hasn't really occurred. There are some things that are up a little bit in price, but we've not seen the large increases that were projected. And I put yet on this because we're not sure which direction it's going to go. Tariffs are technically a tax. The suppliers and the shippers can cover part of that, and yet at some point we probably pay a little bit more. And of course, the goal here is to reduce the trade deficit that I believe was in the neighborhood of about $164 billion. So we're buying more stuff from other countries than we're shipping to them, and this is a way to kind of equalize that a little bit. We do have some tariff-related new construction cost increases, and there were some announcements yesterday that we're going to talk about. We also had Fed Day yesterday, so it was the for economic geeks like us, our day that we're like studying every word and every flinch. There was not a July rate cut, so we'll talk a little bit about that and why that happened, and then we do have some good news. Mortgage spreads have improved a little bit,
They
so
sure have.
that's
Yeah.
yeah, that's helping with rates, right, Chris?
Yeah, it's making it more attractive. And the same time last year, we would have higher rates with the way the spreads were. So we've seen a little bit of a reprieve in that area, and we'll go into that when we get to that point. Yeah.
Yeah, exactly.
Yeah.
We're still talking about Fed replacement. Jerome Powell's term is not up until next year. However, the firing talks have kind of calmed down, and he's been playing a little bit of bully ball between the president and the Fed chairman. Labor markets are cooling. So it's interesting because some of this actually, ironically, could have gone very differently this month and it didn't. So we were surprised by that. I've got an update on the big, beautiful bill, HR1, that was very pro realtor and very pro housing. There's some really cool things that got passed in that legislation. We're going to talk a little bit about builders' confidence and where things are headed, and then mortgage purchase applications, which are actually on the rise. So now they're on the rise, but they're from like historically low numbers. So if we look in, yeah, right. So let's talk a little bit about the tariff top bands. All right. So, and I have you guys in front of me here. So there we go. That is way better. We've not yet seen the inflation pressures, and I talked a little bit about that. Now, yesterday, the Trump administration did announce a 50% tariff on semi-finished copper goods, and this is on top of some of the other tariffs on hard softwoods and appliances and whatnot. This was due to China, Vietnam, and Mexico. They've been flooding the U.S. with cheap tubing, pipe wiring that's been subsidized. So they wanted to clamp down on that. The challenge is there's several hundred pounds of copper that's used in the wiring and in the appliances and throughout new construction. The AC units have a lot of copper in them. So it is likely that we're going to see that going up and pushing some of that new construction pricing up. Now, I believe I have this in here. This is an update. I'm not going to go through all this, but this is an update of where we stand on all of the tariff agreements. Probably one of the big ones was the UK. That was that they're a big, we import a lot of their stuff. They did open up their markets to some of our products that were previously pretty much off limits. But you guys can kind of look through that and see where things stand, and we'll continue to update you. The big one is still going to be China because they're our biggest importer that we import from. And that's still a brouhaha that I'm not sure how that's going to get settled. Chris, any thoughts on the tariffs?
Yeah, we're seeing it's just so uncertain still. And the way that Trump's handling it with the delays and the continued, and what we're seeing now also is the 10-year is not reacting the same way that it used to. So it's kind of like everything's baked in already. So the responses to things that are happening are not as drastic as they were when this first started. We're seeing the pressure on this new construction, especially with their margins. And, I've been losing to new construction when it comes to financing because of they're offering all these great incentives. But I had read online, and I'll have to find the article where it said October is going to be the peak time to buy a new construction home. And if we're looking at how tariffs are coming in and impacting that market, that means that, well, I mean, their margins are only going to get so thin. One thing that they have going for them, of course, as we know, is how they have those low interest rates. And as soon as those go away and I can compete and we have similar rates, they're going to lose that. They're going to get rid of that because they can only go so low. So I see that as a little bit of a success, getting closer to being able to be more of a balanced market for resales, which I know a lot of us are sitting on that kind of inventory right now. So that's just my take on that.
Yeah, I think that's spot on. So when we look at the current impact on new construction costs, National Association of Home Builders is estimating right now it's about $10,900 to the average cost of a single family. And if you go back, I believe it was last month or 2 months ago, we went through all of the housing related tariff policies to kind of show you what those percentages they were increased. Builders are still responding by locking in supplier contracts, offering buy downs, incentives. But one of the things that we're really watching is the new construction starts and the new construction permits are getting towards recessionary lows. And probably the one thing that's saving it is your multifamily permits. There's still some multifamilies that are being permitted and started, and yet I'll show you what those look like. So we're going to start off with inflation. Inflation is that increase in the cost of goods month over month or year over year. This last month, June, the annual inflation rate rose for the third consecutive month to 2.7%. Now it's still down from that really super high of 8.6% that we saw in May of 2022.
Yeah.
I mean, it got so high. We're inching a little bit closer to the Fed's 2% target rate, but the challenge is we literally get a little close to it, and then something happens with tariff policy, and all of these other things are happening, and so we just keep not quite getting there. So it feels like the watched pot. And if we look at the graph, this is going to be your 1-year inflation graph. We look at where. There we go. We look at where we're sitting right now. You can see since April and March, inflation has been ticking back up. Now, this is one of the things that in yesterday's presser, in the Federal Open Market Committee's meeting, Powell used this as cover to say, hey, inflation's not quite under control. We have concerns about the direction it's going to head. We're going to hold steady. Now, from a Fed's economic policy perspective, they're still in a very restrictive mode. So we're not even to neutral Fed policy. We're still restrictive. So it would have been nice to have seen something happen yesterday, because that would have in fact impacted us in the housing industry positively. The challenge is every other industry is booming right now, pretty much. It's just housing, and housing is starting though to be a drag. Now, when we look at this go ahead.
Just real quick, want to add into that. What's really interesting, if you listen to the Fed Powell talk yesterday, he specifically said, the overnight borrowing rate, if we lower our rate, it's not going to impact mortgage rates, by any means. And I found humor in that, because while he's right, it's the overnight borrowing rate, it's not a 30-year, term or whatnot. Everyone's looking at that to make their decisions on what's to come. And we are basing, when I say we, I mean, lenders and such are basing all their pricing on what they know to be today. So to Brian's point, if we would have got a cut yesterday, it was not priced in, it was not expected, we probably would have had a little bit of a free fall in interest rates. It would have been a cascade effect, because, oh my God, I can't believe this is happening. What don't we know? We must have missed it, and we need to now catch up to it. So there is a direct correlation, in my opinion, and I chuckled when he said that.
Yeah, I heard that also. And when we look back, you can see this is going to be your 5-year inflation trend. You can see May of 2022, we were at 8.6. We actually bumped up to 9, I believe, in June, and then we've fallen back over. But we've been pretty steady. So we've generally got inflation under control. But again, the Fed has two mandates: full full employment, which means maintaining unemployment at around 4.5%, and maintaining the inflation rate at about 2%. And if you have wage growth at 4% every year and you've got inflation at 2%, your wages are always going to increase your purchasing power. And those are really the two things that the Fed cares about. Now, Jerome doesn't care about housing. I say that. He's never told me that, obviously, never sent me a text. But the general sense is he cares about these other factors more than housing, and particularly labor over everything else. So one item to pay attention to in this that's kind of interesting is, and again, this ironically gave him a little bit of cover, but inside the inflation numbers is something called core CPI, and this is the consumer price index. This is a bundle of goods that they look at and they say, okay, how much did this go up or down on any given month or year? It was up also 2.7% year over year in June, but the challenge with that is that does exclude food and energy. Both food and energy costs have gone down in the last 12 months, but it includes shelter costs. However, the way that it's calculated, it's a lagging indicator. So it's shelter costs basically from last year when rents were still going up. Rents have started to soften and come down, and the data is suggesting that we're going to see the CPI go down in future months as those new rents kick in. And that could have a very, very positive impact on their position in the future. So this is just kind of one of those numbers that's buried inside there that we want to watch. And it's kind of an interesting story.
It's also important to talk about that, right? They're looking at year over year, 12 months back, and then it's a running calendar, right? So when we see Trump and, Pulte and all these guys that are like yelling at Powell to cut rates, and then we have Powell saying, well, I don't know, look at how people or how they're basing their data, right? So we can see that prices are coming down and we can feel that, but the Fed needs the right month to hit for those averages to get less and less so that they feel more comfortable. It's just a weird process. It's not a weird process. I understand it because data is all they have, but you would think that they could be a little bit more forward thinking, perhaps. That's just my thought.
Well, there's a reason why they say the Fed is old and slow. So there you go.
That's right.
Unemployment fell to 4.1%. This was a little bit of a surprise. We expected unemployment to go up. It's indicating that the labor market is still very strong. And again, this was one of the reasons why the Fed said, well, unemployment's low, we can't cut yet. We don't see labor market data breaking or even softening. Although when you look at the trends, you can see that labor is getting a little softer. And here you see the June 2025 was 4.1%. You can see we were at 4.2 previously. It was expected to be 4.3 or 4.4 was the expectation. And yet, when you look back at the 3-year average, you can see that unemployment rate is just starting to creep up. So you can kind of feel where things are headed. But 4%, that's still full employment, really, technically.
And honestly, the initial jobless claims have been all over the place, and that's an indicator that the Fed wants to see. They want to see people losing their jobs, unfortunately. But it hasn't been going up the way that I feel it should be going up, but they're using the data, right? But the continuing jobless claims of the people that have already lost their jobs has been at now a high, right? So people can't find jobs once they get it back, and so the data is gonna prove itself eventually here. It's just a matter of time.
Yeah, it just feels like the watch pot. It just won't quite boil.
Yeah. Yeah.
When we look at non-farm payroll, it rose by 147,000. So we added 147,000 new non-farm jobs to the labor base. This was strong job creation, but buried inside the number, again, the headline number was strong, but this is the time of the year when states rehire teachers, and over 73,000 of the 147,000 were actually government jobs. This was an irony that it happened the way that it did this month, because if it weren't for that, this number would have looked pretty bad, and it would have again been a trigger or another reason for the Fed to go, it's probably time that we do something. Now, a slowdown can still happen. We still have uncertainty around tariffs, trade, immigration policy. I'm going to talk about that in a moment. This may lead employers to adopt a more cautious hiring stance. And when you talk to people, that I've had conversations with multiple business owners that have said, We know we need to make a hire, and we're just going to kind of kick that can down the road a little bit because we don't know if we want to commit to another salary yet. And I think that's the sentiment that's starting to build out there. So you can just see the 1 year non-farm payroll job increases. We're pretty much at about the 12-month average at 147,000. Now you can see here, this is the 3 year, and you can see how the pace of new job creation has started to kind of go down. And you can just see that we're to draw that arrow, it's just kind of on that downward trend. So the Fed looks at labor over everything else, and even over inflation. So it will take labor breaking for him to actually say, hey, this is time for us to do something. So as it relates to housing permits and starts, this was an interesting statistic this month. Looking at year to date, the US has an oversupply of new construction by 14%. And the way that they measure that is they're building 114 homes for every 100 orders. That means their inventory is building. And one of the economists that Chris and I follow always jokes that the builders are not the march of dimes. They're not in it for the good of being in it. They're in it to make a buck. And so they will start to pull back on those new construction starts, which then of course then creates more of a housing shortage. So it exacerbates the challenge that we already have. But as a result, builders are offering larger rate buy downs, and their confidence continues to fall. And it's really interesting when we look at this. This is the 5-year new construction building permits. And you can just see it's just kind of dropping off the cliff. And we're pretty close to recessionary lows historically. Go ahead, Chris.
I was just saying, you could feel it out there. I've got other people in the industry that are selling new construction, and they're not building the same that they were right now, as you guys are seeing. So it's all happening. The slowdowns are occurring. It's just the delay of this happen. It's all in front of us. We're like, why not yet, right? But it just has to be with the data, and it has to trend.
Yep, you got it. Yeah. And Lindsay said, let me pull that up. Chris, can you read Lindsay's comment?
Yeah, she said, I would argue there's a shortage of luxury new builds. Custom home price points matter. Yeah, I would agree. I think I would agree with her. There is definitely a shortage of that. Builders are going to build houses that are going to sell easily for them so they could be profitable too. So, building large homes, I don't know, while they'll do it, it's just not as much as you would see building their $600,000, $700,000, homes. It's just not the profit's not there, not the same, if you will, in the market we're in today.
Yeah, I agree. And actually, in my prep for this call, I did see some data very specific to that said that builders had shifted into more affordable price ranges because they were expecting, as rates came down, the first-time buyers were going to be more of that segment. I believe the number that I saw is that when we hit 6%, it was 1.4 million first-time buyers that are currently priced out of the market that would come into the market. That's a big buyer pool. And when you look at the fact that we've had anywhere from 1.2 to 1.7 million buyers that should have, or transactions that should have transacted over the last 3 to 4 calendar years, you've got an entire year's worth of sort of, I don't like the pent up demand conversation, but you've got an entire year's worth of transactions that have yet to happen that should have. And at some point, those will kick in. We look at the National Association of Home Builders Market Index. This is their sentiment of like, how do we feel? You can see during COVID, they actually dropped down to a low. Their low point was 30. We're sitting at 33, and we just came off 32 last month. So they are literally feeling as bad about the future of their industry in the short term as what they felt like during COVID and April of 2020. Yeah, that was April of 2020. So they're not feeling so good. When we look at what's happening to the treasuries, and Chris kind of said this, the bond traders, they pay attention to everything, and they're always reacting early to get ahead of what they think is going to happen. And over the last 30 days, when the Liberation Day tariffs were announced, the bond market went crazy. The 10-year treasury went crazy, and we saw some crazy run-ups. This month, we've been trading in the 4.3 to high 4.5 range. So it's been really consistent. I think, and Chris, I'd be interested to see your thoughts. I think that they've probably priced in a little bit of future rate cuts, maybe 25, 35 basis points into this. So if we were to get two cuts, we'd probably see rates come down. With one cut, we might not see a lot of rate decrease. What are your thoughts?
Yeah, I would agree. And let's start off by, the changes that the Fed or the bond traders are doing today. The PCE report came out this morning, right? And the headline PCE was above economists' expectations, and we didn't see, a windfall happen as a result in the 10-year. And what that tells you is like, all right, well, everybody's kind of calm right now. We kind of understand what's to come and where we're at in position, and we're all holding off because of the tariffs and a little bit of uncertainty. So they're not making these what does Logan say? Itchy finger trades, right? They're not making itchy finger trades the same that they were. But as it relates to rate cuts, that I think that they put on their dot plot too. And I think, there's going to be a lot of data that comes out. They don't meet next month. I think they have the Jackson Hole Symposium, right? That's what they're going to be out there in
Yep.
Wyoming. Is that right?
Yep,
And
correct.
so they'll be out there meeting for that and then reconvening in September. And so there'll be a lot of things that happen between now and September that could be a good indicator or not, right? Between jobless claims that can come out in the next 2 months and then anything that happens really in the market with tariffs and all this other stuff, right? So the validity in this and how solid that gets. But again, talking about when we get to mortgage spreads, that can increase too once the lenders have a little bit more certainty in what's happening as the data trends come out. Even if the Fed doesn't cut and doesn't meet next month, right? If the data is starting to show things, the 10-year will react, and then also the spreads will come down, which all this means is lower interest rates.
Yeah, I agree. And the next 60 days are going to be really, really critical for housing because the Fed doesn't have a meeting next month. We have two inflation reports, two job reports, two unemployment reports. We have a lot of data that's going to come out before they meet the next time. So I really think the next 60 days is a critical time for us. Mortgage rates, Chris, do you just want to give us an update on ballpark rates?
There's still about that 6.7 mark as of today. But I did do a quick price comparison here on a $400,000 loan between 7% and 6%. It's a difference of $263 a month, right? At a $400,000 loan, right? So you could see that there's a lot of opportunity for people as these rates come down, and that's why people are flocking to new construction. I sat with a colleague and we were just reviewing a potential, her future, right? And we're talking about new construction, and we're talking about today what rates are. And we looked at a resale at 6.75, call it, and new construction at 4.99, and the difference was over $300 in payments. Like, why can't really afford not to? So rates will be coming down, and that affordability will come back. But I mean, like I said, we're sitting right around that 6.7 mark.
Yeah. Okay, good. Got it. This gives you a little bit of a sense of what happened. The arrow was what happened to the bond market, the 10-year treasury, specifically after the tariffs were announced. And you kind of see that last cycle, like things got a little crazy. And actually that was last year, and the April, the spike that is kind of in this area right here. I think you guys can see that. That was actually the tariff increase. But we've been trading pretty consistently, so it's pretty stable. Overall, July rates remain below the 7% threshold. Spreads have gotten better. When we see mortgage rates get to 6.4 or below, that's where we really spurred demand. So we need those rates to go lower for longer. The question is just, when's that going to happen? When are we going to get there?
And I'll say that, when we get to 6 point, like today it's 6.7, can I get to the low sixes today? Yeah. You pay some points, you can get down there. But when we have that par rate, right, that quote unquote free rate, if you want to use that term, I hate to use that term, but that's just a good way to describe it. We'll probably be able to get under 6 with cost, so it will open up opportunity. And when we get to that point, people will be able to afford more things, and the talk about it will spur some activity.
Yeah, I agree. And of course, Chris, a lot of people don't understand the spreads, which is why I know you and I talk about it a lot. But the spreads is really that difference between how they price the mortgage and what the 10-year treasury rate is. And historically, it's been 1.5% to 2%, or about 1.7%. Now, in really good stable times, you can see 1.5% spreads. So if the 10-year treasury is at 4, you'd have a 5.5% interest rate. At the height of the worst interest rates in 2022, we had we had right at a 3% difference, and that's how we got 8% rates. The good news is we could be higher right now today, and we're not because the spreads have gotten better. But remembering that the federal funds rate, when Jerome Powell and the Fed makes changes, it's correlation, not causation. So it doesn't specifically bring rates down. It does bring down the cost of money to banks, and but it impacts how bond traders react. So about 60 to 65% of the 30-year fixed rate is actually the 10-year treasury. And we kind of call this the slow dance. I show this every couple of months just to kind of remind you. You can see the gray line is actually the federal funds rate. And this was the fastest increase in history. And that's where you see this going up like that with the federal funds rate. You can see the bond market reacted, but you can see the red line is the 10-year treasury and the blue line is 30-year fixed rates. And you can just kind of see they just kind of move together. The greater the space between these two is what we call the spread. Chris, do you want to say anything about that?
Yeah, and if you look back in the 2021, 2020, you could see how tight that line gets, right? And that's really when we had those low 2 and 3% rates. And while we all love those low 2 and 3% rates, it really wasn't so super healthy because look at us now, we have this locked in effect, right? So as we start to look at these numbers come down, we're starting to see a little bit of compression towards the end of this chart, right? Towards the right side of that chart. And that's what we're hopeful for. And that's what I talk about, lenders having more certainty. When they had that steep rise up, that Fed fund rise up, the lenders are like, what's going on? And so they have to protect the house. It is a for-profit company. And so they have to protect the house. They don't want people to go ahead and start refiing really quickly so they could lose business, because the lenders could lose a lot of money during refi booms. If you think about it, how many loans can close out and go elsewhere? So the slow dance happened where they just got, I guess, angry at each other because they just built in risk and uncertainty. And now as we're moving, we're seeing less of that ups and downs as the data comes out, because it's getting clearer what's happening.
Yeah, and some tariff deals would actually take some of that risk out of it. So
yep.
Spreads right now 2.3%. So you could see a 30 basis point, maybe a 40 basis point, 50 basis point drop in, which would be about a half a percent if spreads were to return to normal. So again, to Chris's point, this just reflects market volatility, prepayment risk, because they're concerned that, hey, people that if mortgages drop, they'll refi, and that can really hurt the bank's bottom lines, and just low demand for mortgage-backed securities currently.
And so, talking about the Fed not meeting next month and waiting 2 months and all the data that's coming out, that's what we're talking about. The mortgage companies can adjust their spreads as this is happening and as that data comes out, right? So if the data was really great, we could have a spread that gets us to 6% without even getting that Fed meeting. Now, I don't forecast that happening at this point, but what I'm getting at is it can tighten up a little bit closer, and that's what we're hoping for. And if that starts happening, then there's going to be indicators that, hey, September really is going to be a rate cut, and that'd be a blessing for us all.
Yeah, it would be. And that's a really great point, actually. Yeah. Now, this is kind of an interesting statistic, and we always have to be careful using percentages, because percentages can hide really, really low or really, really high points in the past. But mortgage purchase applications are 13% higher than the absolute low that they were at a year ago. And we've had 26 weeks of growth, and we've actually had 13 weeks of double-digit growth. Now, what it appears to be, because we don't see a whole bunch of people running out and writing offers, what it appears to be is sellers that are putting their home on the market, that are getting positioned, are starting to apply to make sure that they're able to get financing on their new home. So we're going to watch that really closely. And of course, refi demand is still very, very weak. It's only if they have to are they generally refiing right now. Although the longer that we go, the more people will have an interest rate more similar to where we are today, so that quasi lock-in effect eventually will start to just dissipate just with time. You can see here is the MBA purchase index. Mortgage Bankers Association purchase index is on a steady incline. However, when you look at it in this perspective, you see how absolutely low the trough has gotten in terms of mortgage purchase applications. And you can just see that we're just, I mean, nowhere compared to where we were 2021, 2022 levels. So we've got a ways to go. Chris, any commentary on that?
Not so much. I just wanted to say that we're now back to pre-pandemic. After 5 years of not enough inventory in our market, we're back to pre-pandemic levels, and that's kind of exciting because that means there's inventory out there. But how quick is that going to last once these interest rates drop?
Yep, I agree. And by the way, Kevin said that the state of Florida just passed legislation to lower auto insurance. That would put more money back into people's pockets, which is nice. And let's see, more government agencies are pushing affordable housing. Yes, in fact, the big beautiful bill actually talked about that. So yesterday was the presser with Jerome Powell. He defied Trump's very public pressure to slash rates. If you guys have seen the image of the two of them standing with the construction hats on at the job site there at the Fed, and he kind of slaps him on the back, and it was awkward because he hit him pretty hard. He said, "We need to lower rates," and he kind of Jerome Powell he kind of took a little bit of a slap to the back. It was a little comical. The two of them, he actually put Powell into place in his first term, and they have not seen eye to eye at all. So Powell made it clear that the Fed's priority is only on taming inflation, not accommodating political demands. And he said, despite heightened uncertainty and downside risk, the U.S. economy is still in a solid position. So with inflation still above the targets and tariffs fueling some prices again, the Fed signaled no imminent rate cuts. Now, I don't know about you, Chris, but I was a little bit surprised that they didn't tip their hand at all. It felt very, very solid.
I'm not. I didn't expect it to happen. I hoped that it happened, but I did not expect it. If we think about what's happening in the economy, we have a highly restrictive policy, yet the economy is booming. So, we don't like what Powell's doing because it impacts our market, but is he really handling it the right way? Perhaps. I know that people are suffering, but the idea is for, during this time to raise these Fed fund rates is to slow down the economy. The economy really isn't slowing down at a pace that, it requires all this extra cutting to really happen just yet, as the numbers say. That might not necessarily be the reality, but as the data say. So you can't hate on Powell too much because he's kind of doing his job. And I mean, if you really wanted to, like he mentioned in the call yesterday, in the interview yesterday, commentary that, we didn't cut or raise rates, he said. And he specifically said that, right? And, there's an argument to say, well, if you raised it, would have made this happen any sooner? I don't know. But should you have not have cut before the election last year? Probably not. But that's another conversation. So I think that Powell is, from an economic standpoint, you got to look at our country. Things are doing pretty good. We're at a 2.7% inflation rate with a highly restrictive policy, and the S&P 500 is hitting record numbers. Bitcoin's hitting record numbers. We're seeing stocks hit record numbers, and but our housing is really impacted, hyper locally especially. So I mean, in the rest of the nation, housing isn't as bad as we have it here. We're feeling a pain that I don't think any other state really is feeling, similar to us. Maybe a little bit in Texas, maybe
Texas, Texas would be the one.
Yeah, maybe Texas, right? So we're feeling constrained, especially in Florida, especially in Southwest Florida, just because we had the highest levels of appreciation during COVID. So we have like the triple whammy thing, quadruple whammy happening to us. But when Florida starts to hit again and Southwest Florida starts to hit, there's no other market like it. We just got to get to that point.
Yeah, I agree. Here's a couple of ironies. Powell did acknowledge that there was some risk to labor force, so he's paying attention to that. But he kind of, and I'm sure I saw Trump made an announcement today about this, and I haven't seen the quote, but I'm sure it was probably not pretty. But Powell used the slowing immigration, which leads to less labor force and then less unemployment growth, as cover. And so basically he said, hey, look, we shut off the border. There's fewer people coming in. That means we're going to see some things like we're going to see less of these other things happening as a result. There's fewer people seeking jobs, and he used that sort of against Trump. And so that was kind of interesting. Now, the other thing that was interesting about this meeting is we had two Fed officials dissent, Bauman and Waller, and that was the first time in 3 decades. I believe it was 1993, the
That's
last time
crazy.
you had
Yeah. 93,
two
right? Yeah.
dissenters. Yeah.
Yeah.
So now Waller is probably the likely shoe-in to replace Jerome Powell, and he is extremely pro housing. So that would be really good for us, without any question. But the two of them both wanted cuts and were pushing hard. So they, if he's the shadow Fed, so to speak, in other words, if they announced that Waller would be the next or Bauman, either one, the commentary that they can have internally with the other Fed officials could really kind of change and guide and almost put them in a position where they can't make the decision for Powell, but they can make statements that would actually move the market. And the two of them, the blockout period stops tomorrow, so they're going to be both speaking tomorrow. I saw, so I'll be interested in their commentary.
I just want to touch back on that immigration piece for a second. I looked
Yeah.
up on this year on, using AI. It said in June of 24, immigrants made up 19% of the U.S. workforce, 32 million people. So there could be, if if that number's true, right? There is an impact to that.
Yeah, that's an impact. And when you look
Yeah.
at the population growth since 1995, it's been 72 million, which is why when we look at US home sales, which are bumping right at that 4 million, I did not include those this month, but we're bumping right against 4 million, which is a historical low. And when you look at it based on history, that's when adjusted for inflate or for job growth, population growth, I'm sorry, that's the lowest sales pace in the history of the US. So if it feels hard, I keep saying this, if it feels hard, it's because it's never actually technically been harder than right now. So I'm going to include this in the email that I send out, but the HR1, the one big beautiful bill, was very pro housing and very pro realtor. One thing that is really important for everyone on this call, because it applies to all of us, was the 20% qualified business income deduction. It was made permanent and it was set to expire. So that means that 20% of your self-employed income becomes deductible, which means if you earned 100,000, it's really only going to be 80 that is sort of your starting point. So that's a major tax benefit for housing. As it relates to affordable housing, there were some low income tax housing credits that are estimated to create about 500,000 affordable rentals through the next decade. We did have some opportunity zone expansions, which are generally kind of blighted areas that become investment opportunities. And when you put your money in that, your returns in your stepped up capital gains go away after 10 years. So it's bringing money into special areas. I think the biggest one was the mortgage insurance and the SALT deductions. I highlighted that mortgage insurance deduction was reinstated, and so for the average borrower that uses mortgage insurance, about $2,400 a year of benefit. That's $200 a month. That helps.
A lot.
We're in a higher tax state, especially in coastal areas. So the SALT was raised from 10,000 to 40,000. Now that was a little bit of a tit for tat that we gave to that Trump gave to the high tax states, but this does benefit Florida for sure. And then there were some other real estate tax provisions that were made permanent. The Section 179 depreciation was permanently extended, so that's a big deal. We've got some HUD grants that came in and some regulatory reform where they're trying to peel back some of the red tape. And having just gone through the process of building new construction in Sarasota, there is a lot of red tape. It is crazy out there. So let's accelerate forward and let's just look at national. And I'm just going to run through these just to give you an idea. These will all be out there nationally. To Chris's commentary earlier, it's still a seller's market. When you look across the nation, and the median list price across the US is 455,000. You've got average days on the market of 105, so not terrible, below your historical numbers. You've got 42% have taken a price decrease, and historically you'll see 34% of properties taking a price decrease. And we are at 860,000 of single family available housing stock. Now, these numbers come from Altos data, and Altos data tracks every home for sale in the US every single day, but it does scrub out data when you've got like a new construction that's in the MLS and it's, going to be 18 months out to build it and construct it, they take those out. So these are how many homes could go and be bought today and could be moved into within 60 or 90 days. 860,000. We historically have been somewhere between about 1.2 and 1.4 million. So we're still at low levels, but we've seen that rise quite a bit up since the all-time lows. So when we look at the last month, US inventory grew by 3.6%. So we're still seeing more sellers coming onto the market. If we look at, sorry, I've got a box in front of me. There we go. That's better. When we look at the condo markets, there's 230,000 condos for sale. This has barely moved in the last month. We went from 229 to 230. So the condo market is we're not seeing the run-ups in terms of inventory that we were seeing earlier this year. 127 days average on the market, and we've seen
why don't
30.
Oh, I'm sorry. Go ahead. Continue.
Yeah, no.
When you're done with this, I'll touch on the condo financing one page.
Sure. Yeah. So price decreases were at 37%, and market action 32. So generally, it's still a little bit of a seller's market, but it's definitely softening. Chris, do you want to touch on the
just jump in
condo?
real quick. Yeah. If Brad's in here, Brad, drop that condo financing flyer into the chat. Again, I have a one pager for you guys that I created with everything going on in the market. Florida's condos are kind of all over the place. We are seeing assessments, crazy HOAs, crazy insurance stuff. So I did a little one pager that gives you some information about financing a condo. In there, what you'll see is the difference between what's called a warrantable or non-warrantable condo. And basically all that means is warrantable can be Fannie or Freddie. Non-warrantable is some other type of financing or no financing at all. Right, non-warrantable. So in there's some little red flags that you got to look out for litigation and other things. So take a look at that one pager so that you can have it for your notes. So when you're going in to buy a condo or list a condo, you want to ask some of these questions up front to see what's happening. And especially if you're a newer agent, a lot of the barrier islands, Siesta Key, Longboat Key, they have some really unique properties on there that are probably not financeable the way that you would think. So take a look at that. And if you have any questions, please reach out to me.
And agents don't always know that, do they, Chris?
Yeah. It's interesting.
Listing agents.
It's listed, you just don't know what you don't know. So you could be calling another agent in there and they'd be giving you the wrong information. So you just got to be asking the HOA the right questions and just getting the right documentation. And so that little one pager will help you at least guide you on the right path.
Yeah, that's great. Okay, good. So you can see the national inventory trends. We're trending upward. Average days on the market. Of course, the rest of the country's in their summer season. We're in our winter season right now. Properties with price decreases. You can see we've been kind of in that 30-40% range, coming off the lows of 16% back in 2022. If we look at the number of relist properties, they're headed back up. Currently about 10% of inventory is getting relisted. In Florida, some of the numbers are showing that some of the inventory is actually not getting relisted, which is interesting. When we look at the tranches of median list price, you can see the seasonality in that upper end market that really fluctuates based on the time of the year. You can see that median list price has still continued to increase nationally, even in all four segments. So it's been trending up. The upper 50% is a little more price conscious. If we bring this down to Florida and we really look at where we are in Florida, across the state, the median list price is right at $500,000. Currently in Florida, we're at about 129 average days on the market, with the median being 91. So the middle point of all listings above and below is 91 days. 47% have taken price decreases. So that's almost 1 in 2. 2% have taken price increases. I have no idea who those foolish sellers are, but those are probably new construction that got priced and then had to get repriced up. And in Florida, we have 104,000. So 1 out of 8 homes for sale are currently in Florida. And the last time I looked at the statistic between condos and single families, Florida and Texas made up almost 50% of all inventory in the US. And it was, I believe it was 31% was just Florida. So we are just sitting on a glut of inventory right now. And that's that pressure that you feel.
And Brian, I want to add, the last 3 appraisals I had done, now just thinking about it, all came in over ask, over contract price, right? So good job on all you guys negotiating for your clients the right way to get the right deal. But that's interesting when you're seeing all these price decreases. We're seeing price increases so low, but yet when I've done my last 3 appraisals that I have gone out, have all come over the asking price. Some one 15,000, another one 9,000, and another one almost 20,000 over ask. And
Yeah.
it's
Wow.
incredible. And so again, if it's priced right, it'll sell. And congrats on those listing agents and buyers agents that are, or I should say,
Yeah.
buyers agents that are doing that, right?
That's great. And by the way, that's a great opportunity to, as a buyer, use some of that as a 2-1 buy down and actually just save your buyer some money on their payments over the next 2 years.
And so what he's saying in that context, right? So I'm glad you brought that up, right? So whenever you have a house that over appraises, you can bump up the sales price and take credit back out of it, right? So that is an option, right? Bump up the sales price, adjust the contract to have the seller now credit that buy down, like you're saying, if you want to go that route and take advantage of it. Yeah.
Yeah. Save yourself some interest. Okay, good. If we look at just month over month, median list price in Florida is staying very similar. Days on the market's creeping up. Price decreases are pretty similar. Inventory is actually down just a little bit. So we had 106,000 inventory last month, 104. These are single families, not condos. This is just residential. We look at the condo market, we are in buyer territory now in the condo market. And 27 starts to become pretty, especially the way that the Altos data looks, 27, that starts to make that a good position for buyers to negotiate. The median list price of a condo in Florida, 345. Median days our average days on the market, 169 with median
Wow.
120. So things are sitting and it's time to prepare your condo sellers for the reality. And some of that is some of the Keystone inspection, the insurance cost. There's a lot of factors there that are factoring into that. When we compare this, we can see that last month there was 73,000 condos on the market in Florida. We're at 69. So some of those sellers are taking their homes off the market, and that's not to be surprised, given that we're really in our winter market in Florida, where this is the summer market in other areas. So if we look at some local counties, I'm going to start with Manatee County first. We are still in seller's market in Manatee County. Median list price is about 598,000. Average days on the market, 118, so in that ballpark 4-month time frame. 54% of properties have taken a price decrease, which is headed down. 2% have increased. 4% relisted, and there's currently 2,701 active available single family properties in Manatee County. If we look at condos, Manatee is still a little bit in the buyer's advantage. 300,000 median list price, 144 days average days on the market, and about 47% price decreases. So we're trending in that 1 out of 2 taking a price decrease at any given point. When we look at inventory, we're currently 2,701 available, up from the low in 2022 of 268 homes for sale. Just crazy. You can see that average days on the market climbing from that low of 32 days on the market, which was kind of savagely unhealthy market that we were in. I think it's important to know that this inventory growth, even though it's been painful, is actually healthy for this market. The inventory growth is going to get us back to a spot where when rates do fall, about 8 out of 10 buyers bring a listing to the market. That means listing inventory can actually grow at the same time that sales pace can grow. We're going to be in a lot better place than we were 2-3 years ago. Median list price, you can kind of see where that's at. The one consistent I'm seeing in the data, and I didn't put this in here, but I did have some analysis. We just had a lot to cover today. We're not really seeing prices going backwards. So in other words, values are not going down. It's just the pace of the increases have the slope of the curve has just flattened out. So you can't price things like you could 3 years ago. We've got to be a lot more sensitive, but we've not seen the data yet that shows that homes are depreciating. It's just very flat appreciation. And that's across all 3 counties. Price decreases by the tranches. You can see that your upper end is taking a lot more price decreases than your lower end properties. We look at Charlotte County, 419.9 is the median list price. We're still buyer advantage in Charlotte County. So this actually improved a little bit since last month. The condo market, let me go back. I'm sorry. 162 days average for a single family in Charlotte County. So days on market starting to get up there a little bit. Median's almost 130. So, 4.5 months. Price decrease is 48%. When we look at the condos, you can see that condo has fallen quite a bit on the median list price, 275. We're in pretty deep buyer territory for the condo market down there. And 39% have taken price decreases. We are currently sitting on 926 condos for sale in Charlotte County. When we look at single family, you can see we're sitting at about 3,100 in Charlotte, up from the low of 282. The average days on the market continues to climb. That's a pretty straight gradual increase. So this is, it's taking longer for sellers to be able to get their prices. And when we look at median list price, you can kind of see that trend. It's starting to flatten out. It's not really going down. It's just not going up, which means the speculative pricing that people were willing to pay a couple of years ago has just gotten more realistic. And I think that's important because Chris, I know you're like me. I see all this. We're having a housing crash. Prices are just, bottoming out in Florida, and they picked one house over in, I forget where it was, Boca. I forget where that house was. They're like, it sold a couple years ago for this price, and it just resold for this price. Oh my God. Well, there's a lot of like doom and gloom people out there and that your clients are listening to. So that's why it's important for you to be able to be the perspective. Chris, any commentary on that?
Yeah, I follow a guy on X. He's actually a local guy to Florida. His name's Kirk, and he posts something called like the rinse of the day. And he'll go on here and he'll here's one. It was bought bought in September 27, 2024 for like 1.7, and now it's being listed for 1.2. So there are things like that are out there, but you also have to remember that people overpaid incredibly for the homes here in Florida at times. Like they put extra money to do that. But to your point, like even the foreclosure people that are like, oh my God, there's gonna be a whole mess of foreclosure, everybody's gonna lose their house and whatnot. Listen, there's like 30 to 40% equity in everybody's houses nationwide. I mean,
Yeah, exactly. Yeah.
yeah.
It's not, and that's what makes it different than 2008. Is 2008 was a job loss recession. People had to sell because they had no job. That's a very different. That's a very different circumstance from today. So Charlotte County. Oh,
and
go
homes
ahead.
were over leveraged. Lending was different then, and homes were over leveraged, and you had negative amortization loans, and you can get a loan just by saying on a piece of paper, I'm the manager at, we'll just say Burger King, and I make $100,000. Here's a loan. Bam. I talked to an account executive today, and he was like, back in the day, in the heyday, I used to be able to lock loans in a 3-day window. He's like, well, I'm ready to do it. Bam, just click the button and go. And we would close the loan because it could happen that quickly. So there's a lot of other factors that were impacted during that time too, right?
Yeah, pick a pay loan where you could pick what your payment was, and yeah, that's just crazy.
Yeah.
And I think it's important that agents know that the Frank Dodd Act in 2010 created the qualified mortgage rule, and that changed everything. And that's where we have just so much more sensible lending guidelines. Sometimes it feels restrictive. I don't disagree with that. And it really brought safety to the mortgage-backed securities market that we had not had. So we look at price decreases. You can see the trends amongst all four tranches of pricing. They're following pretty similar, and that brings us down to or up to Sarasota County. Median list price Sarasota 550. We're sitting at 142 days average, with 112 being the median days on the market. So very similar trend. 52% price decreases. So 1 out of 2 again are taking price decreases, and only 4% getting relisted back on the market. We're still in a slight seller's advantage in Sarasota, the condo market.
Hold on real quick, real quick, Brian, going back to that last slide. So
yeah, go ahead.
I've been in Sarasota now 18 years. I've been doing mortgages for the last 9. And I think I might get some heat for this comment, but I can't believe that I looked at median list price for Manatee versus Sarasota. I can't believe that the median list price is higher in Manatee County than Sarasota. When I just, that boggles my mind. If it, not to offend anybody, but back, everybody was like, yeah, you want to live in Sarasota? Who wants to live in Manatee County? You know what I mean? It was like just like, oh, who wanted to live down in other areas of Florida, right? It was just like the consensus, and I'm just blown away that Manatee County is really beating Sarasota up over here.
Yeah, well, you've
Yeah.
got so much of Lakewood Ranch that's new
That's true.
construction,
Yeah,
and
yeah,
that's all
yeah.
Manatee County. So
Right. That's
I agree.
facts.
I look at that. I thought the same thing.
Yeah.
So when we look at the condo market, we are sitting at about 400 on the median price, 141 days on the market with 112 median, and we are in buyer advantage territory in that area also. You can see the growth. We've got 3,600. We have 3,600 single family homes available, up from that crazy low of 328 in March of 2022. And I think these are good slides to be able to show your sellers so that they understand the market that we're in today is not the market that we were in a couple of years ago. Days on the market, you can see the growth trend on days on the market as inventory has built. And then you can kind of see that median price. It did drop a little bit last year, which is interesting. That was a high interest rate period, January 2025. January 24 was a little higher. So you can see we did bottom out a little bit, but that median list price has increased back up. You can see median list by the tranches here. Bottom is pretty consistent, and to Lindsay Ashley's point, that upper end, you can see the little bit more variability in that high end market. Properties with price decreases are starting to trend down a little bit. I think this is where people are starting to take the homes off the market. They're starting to just say, hey, we're just going to sit and wait, which is probably the worst thing that they can do. But we're at 52.4% price decreases. And you can kind of see this. Your lower tier price properties have taken fewer price reduction, those upper tiers, which just doesn't really surprise you at all. So I've got just a couple talking points. What does this all mean? How do you interpret it? How do you take this data and go use it with your clients? So I put together some just different things that you can say, or some talk tracks as it relates to just median prices or just the price trends. For a buyer, prices have softened, but they've not crashed. This is your window to get in without overpaying and still build equity as the market rebounds. And I think that's really important, because we will see we're setting ourselves up for probably about a 5 to 7 year housing market that is going to be gangbusters. But we've got to make it through the next roughly probably 6 to 9 months to be able to get to the other side of that. And honestly, I thought we were going to be here by now, and we're just not quite there yet. Sellers, yes, prices are down, but serious buyers are still active. The reality is that if people are buying a house at 6.75% rates with everything else that's going on, they're serious. So price it right, you'll still walk away with a win. Price it wrong, and you'll sit. And by the way, what happens as a seller, they get to do as a buyer when they buy up. So they get to have that same benefit that the buyer is getting on their house. As it relates to just the price trends last year over this year, it's important that we talk to buyers and explain that we're not in a bubble. Price per square foot has held steady. That tells us the market's stable and not slipping. You're buying into value where previously you were buying into like just crazy, a crazy market. For a seller, flat price per square foot means buyers are value conscious. Let's focus on condition and upgrades. They're looking for turnkey. They want it to look and smell good. You don't want to have the bow wow house that barks at you from the curb when you pull up. So everything matters.
I've got
First
something I
impressions
want to
matter.
want to
Yeah, go
throw
for it.
into the talking point for buyers and prices softening. So I saved this little clip that I found, and what it mentioned is that mortgage rates dropped from January 2020 to August 23, and home prices jumped 41% nationwide during that time. At one point, prices were rising at 11% a year, which is a Case-Shiller index. So what does that tell you? That shows that if rates drop again, history shows demand will surge. I think we all can agree to that, right? And prices potentially could take off the same way. Now, I don't know that we're going to see this 41% gain again. That I don't think we'll see. But let's just take a real life example. A 400K home at 10% down with a 6.75 rate, the principal and interest is 23.35. So let's just assume that rates drop, but the prices of the homes only go up 12.5%. That same home is now $100 more per month, roughly, in mortgage payment at a 5.99 rate, right? So the compare and contrast is the people that are saying, hey, I want to wait this out, I want to get lower rates. Well, especially in our area, history has told us that when that happens, we see our home values rise, and you might have a lower rate now, but the offset is your value of the home's higher. So we're net even. Good talking point.
Yeah, that's a great point. And again, that's where a 1.0 or a 2.1 buy down, like that's where it comes in. If I had a listing in this market, I would not be listing it without offering some form of special financing to the buyer to be able to stand out, because you've got to have a point of differentiation.
Yeah, and here's a good talking point. You just pretty much ask them, would you rather win on price today or gamble on rate tomorrow? That's where we're at.
Great one. Yeah. It's a great one. Days on the market, buyers, homes are not flying off the shelf anymore. You've got time to breathe. You've got time to negotiate and choose wisely. So we don't have to be in that panic mode that we were in. So that gives them some speculation time. For a seller, buyers have more options again, which means your first impression matters. That's what I was saying earlier. We need to make a strong, we need strong marketing, spot on pricing, and patience, and recognizing that, setting the seller up that, hey, this may take anywhere from 30 to 150 days to sell. So we want to manage that expectation. Here's what you're going to hear from us. We're going to check in with you every Tuesday, every Thursday, whatever your check-in pace is. And, we always want to make sure that we're maintaining that communication flow with the seller, because they get frustrated when they have no showings, or it's been 3 weeks and they haven't heard from an agent. That sends the wrong message. As it relates to list to sales price ratio, sellers are giving up for buyers. Sellers are giving up roughly 3% on average. It's real money. We'll use that to leverage to negotiate hard and win the right deal, or buy the rate down. Again, for a seller, almost no one's getting full price right now. If you're not priced competitively, you'll be the comp that makes other listings look good. I call that the pinball listing. Someone looks at us, they bounce off us, and they go buy something else. So you just don't want to be that pinball listing. And then as it relates to inventory levels, for a buyer, explaining inventory is up. That's code for you're no longer competing with 10 offers. You can be selective and negotiate better terms. For a seller, just explaining this isn't 2021. You've got competition, and we're going to win by being the best looking, best priced, easiest to buy property. And it's all about price, timing, and convenience for the seller. So sales pace, just how fast things are selling for the buyer. It's no more buy it unseen madness. We're in a market where you have room to think and offer strategically. And by the way, these are words I'm giving you because you could take these and do a reel with these. You could put them on your Facebook post, your Instagram post. There are things that you can do with these to actually generate buyer activity. For a seller, this isn't a seller's market. It's a smart seller's market. Presentation and pricing are the only two things that matter now. And I think we can all agree with that. Two more just things for sellers. There's more signs in the yard, but the same number of buyers walking through. You don't get a second shot, so make it count. Make the first shot count. And the longer a home sits, the cooler it gets. Let's avoid the stale listing trap with the right price and upfront punch. And of course, we looked last month at the data. Properties that were well priced were still selling in about 30 days. For about 5% off list, 3 to 5% off, depending on the county. If they were overpriced and had to take one or more price reductions, they were taking on average about 140 days to sell, and they were selling at about 85% of the final price, or the original list price. So they were it was costing them to overprice. I think that's really important. Okay. All right. So with that said, that brings us to the end of the presentation this month. And I know there's a couple of questions. With all this said, What do you think the state of the rental market is? How's the rental market going to impact the housing market in our area for next quarter? It's a good question. Chris, do you have a commentary on that?
Well, I mean, everything's expensive, and it's going to take people to realize the costs are coming down overall to want to move here. The average person that's going to rent, it's going to be, your server, your industry person. That's a lot of the people that are going to be in rentals, and that market's really hurting, especially in our area. My brother owns a restaurant. Sales are down across the board in that space. How is it going to impact our market? Well, if there's more inventory, that means home values are coming down. And, some of the doom and gloomers really want the values of properties to lose all that 30% that we gained, right? I mean, it was overinflated and unjustified. If you ask some people, it was government controlled and done. So, it'll impact it in such a way that if there's overabundance of places to live, that means things will sit. That means prices will come back down. That'll increase affordability in the long term. That's my thought on it.
Yeah, and I think that, and it's a really good question, Lindsay, that you asked. When you look at the lag effect of when multifamily, so 5 units and above, when you look at the lag effect when they start a project, it takes them an average of, I believe it's 19 or 21 months to complete a typical multifamily build on
Yeah.
average. So we have a whole bunch of people that saw, migration patterns moving into Florida. The builders and the developers started those projects 2 years ago. They've come online now, or 3 years ago, they've come online now. And now you don't see the new things happening. So we probably have 12 to 18 months of soft rents as the market catches up, and then we're probably going to be in 3 years in a period of time where we have a housing or a rental shortage again. So it's everything goes up, comes down, and vice versa.
And to that point, that goes back to that year over year data that they're looking at, and housing numbers and rents, and how that measures inflation. And Lindsay, you're very valid, right? So if that catches up, that the Fed will use that as a measure towards making decisions and cutting in the future.
Patrick asked if someone refers to Echelon, is there a disclosure? Yes, we have the affiliated business arrangement disclosure that I will send out. Make sure that you guys have that, and that's the document that says, "Hey, we're a sister company, so we want to make sure that we do capture those under RESPA." And Faith, you're welcome. We're glad that we could add. We're glad that we could add value to you guys. So, with that said, any other questions, comments, concerns, curiosities? Give Chris a high five if this was value, and thank you for that. Any other questions we can answer for you guys?
Open season, what you got?
Said thank you, so that's fantastic. All right, Lindsay's clapping. That's great. All right, well, if you guys do have any questions, let me know. I will send these out to you so that you can put these in your listing presentations. And we appreciate you guys. Go do what you do best, service your clients, use this information to take your unfair share in the marketplace. And if you need any help with anything, see a member of the leadership team. And if you need mortgage or any kind of just questions in that space, Chris is always available to help. And we've got our second closing happening here in a couple of days. So we're rocking and rolling with that. And we appreciate everyone supporting us.
Yeah, thank you guys for coming on the call today. We really appreciate it.
Yep. Cheers, everybody. Thank you.